Welcome to the Screencast on financial statements. Financial statements are necessary for the understanding and communication of accounting information. Without them, things can get pretty messy. One of the most fundamental questions that can be asked of a business is the business profitable? To answer this, we look at the statement of comprehensive income. It commonly goes by a few names: the income statement, the profit and loss statement, or the revenue statement. They all refer to the same statement governed by the formula revenue minus expenses equals net profit or loss, preferably profit. This would give us a single-step statement of comprehensive income. However, a multi-step one provides more detail. In this example, we can see that sales revenue minus cost of goods sold equals gross profit. After all expenses are deducted from gross profit, we have profit before tax, and finally net profit. Another important aspect for a business is making sure that the business is aware of what it owns and what it owes. The statement of financial position, or balance sheet, shows just that, displaying a company's assets, liabilities, and equity for a point in time. It is home to the accounting equation: assets equals liabilities plus equity. Here we can see that assets are specifically current or non-current, as are liabilities. This side must always equal this side, in order for the accounting equation to be in balance, hence the name balance sheet. The statement of changes in equity shows the growth and distribution of equity and, most importantly, the changes in retained earnings. The retained earnings balance at the beginning of the period plus net profit minus dividends gives you the retained earnings at the end of the period. This can be seen in this example of the same business used previously. Management of cash is important for any business. A business must be aware of the cash coming in and going out. The cash flow statement records all cash inflows and outflows, which are categorized under operating, investing, and financing activities. The sum of all cash flows from each kind of activity gives the net increase or decrease in cash. Here's an example. Adding up the cash flows from operating, investing, and financing activities gives the net increase in cash. This number is then added to the cash balance at the beginning of the period to give the cash balance at the end of the period. So those are the four main financial statements. While they're all each used for different purposes, one cannot exist without the other. They're in a pretty serious long-term relationship. The net profit balance that is produced on the statement of comprehensive income is used in the statement of changes in equity to find the retained earnings. Speaking of which, the retained earnings balance appears on the statement of financial position, as does the ending cash balance of the cash flow statement. So as you can see, this relationship is pretty deep. So that sums up financial statements. Thanks for watching.